Good afternoon. Thank you for coming in and joining us for this session on looking at issues around finance and finance flows for green transitions. So I have with me a very distinguished panel, and I will be introducing them in a little while. But before that, I just wanted to sort of bring your attention to the fact that the call for finance for sustainable development is really not new. And in fact, if we look back in 2002 at the Monterrey Consensus, where heads of states got together to actually talk about finance and looking at finance to achieve developmental goals, a lot of it was already set out at that point in time. We talked about public finance, we talked about private finance at that point, talked about an enabling environment and different sets of actors, different instruments which can actually help in this type of financial flows. So that really set the stage for linking finance to the achievement of developmental goals, because there was an acknowledgement across to say that whether it is the Millennium Development Goals or any other set of goals that we were talking about, achieving them was near impossible without making provision for finance. This was sort of reiterated by the Doha Declaration, which talked about keeping the focus on finance, even though the world was going through one of its worst financial crises at that time, and sort of getting the commitment from some of the other heads of states saying that, yes, we really need to keep this going in spite of the troubles that we are currently facing, and we want to see how that can happen. The Addis Ababa agenda, which came out in 2015, sort of again reaffirmed the need for dedicated attention to this space. So it's not really new. However, one of the things that keep plaguing this whole space is the fact that the requirements are way beyond what is currently available. So one of the things that a report which is soon be, at the end of this session will be launched, talks about the need for dedicated finance and what we have available. And Professor Alan Jones, in fact, makes the commitment that even for an area just like, just in terms of energy and clean energy, he says that developing countries will probably require anywhere in the tune of 500 billion in terms of annually as investments to achieve the renewable goals. So it's a difficult task, and I have with me a set of very distinguished panelists as such, and we would like to hear from them in terms of what they think can help solve this riddle, this situation. So I'll just briefly introduce them. So I have Geraldine with me, policy analyst for green investment in OECD. I have got Kanika Chawla, senior program lead, Council on Energy, Environment and Water in India. I've got Sumant Sinha, who is the chairman and managing director of Renew Power in India. And I've got Jonathan Charles with me, managing director of the European Bank for Reconstruction and Development. And I'm from the John D. and Catherine T. MacArthur Foundation. We are a private foundation in the US, but we work on the climate change issues in India. So I will ask my panelists a set of questions to start with and hear them out, see what, and at the end, I'm hoping that we will have time for a question-hour session, and we will see where this takes us. Thank you. So I'll start with Kanika, really, if that's okay. Kanika, I know CEW has been involved in looking at finance and financial flows in energy space for quite some time. So I would like to get your views on a couple of questions. What, in your view, are the three topmost constraints that you think which is holding back the flow of finance? What are the ways of addressing them? And the second question I had for you was that, how can we leverage the SDG framework, which came into effect in 2015, to leverage more financing for development, if at all?
Okay. Thank you, Matushi, and thank you also to the Observer Research Foundation for having us here today. I wish I had sort of very precise answers to that, and then the world would be a better place, and I would be a billionaire. But that being said, I think that in my mind, the principal challenges for renewable energy in India at the moment are, I would say, twofold. So I still do have 3 answers, but I would still categorize them in 2 buckets. So one is legacy issues of the power sector, and then the other one is lack of clarity on where policy stands on some of the trade-offs. So in the second bucket, for instance, there are sort of in any energy transition or in any kind of transition for that matter, there are several trade-offs. We just don't know which side of the trade-off we want to pick. So I'm going to start with that and then go into the power sector issues. So for instance, we're in this phase or when we're thinking about do we want to create domestic manufacturing, and there is a very strong energy security sort of prerogative that drives that line of thinking, and none of that is invalid. It's just perhaps the timing of it is a bit off, and I wish that we had thought of that before we sort of signaled the creation of a market with an end date. And before we did this low price discovery that everybody has found quite attractive, all the stakeholders, especially utilities, and now they obviously don't want to go sort of backwards or upwards on the price range, right? So in that context, I think that that's a trade-off that we need to have a clear view on. Again, do we want to have cheapest per unit of electricity, or do we want to have economy-wide, system-wide, cheapest cost of transition, right? And then the two would look very different. The balance of how much distributed renewables versus how much transmission extension you're going to do. So some of those questions, I think that there continues to be lack of strategic policy direction and signaling, which I find quite problematic, and I know from an investor's point of view, and Sumant can perhaps also chime in on what impact that has on companies or on actual deployers, people who have skin in the game. But the more problematic issue, because this is also a matter of communications. You communicate that this is a problem, and quite quickly you can sort of, the government can take a view and signal more effectively. But then there are legacy issues of the power sector that in my view, pose 2 very big challenges. So one of the things that we hear a lot about is counterparty risk, which is a function of sort of the offtake or the utilities being in bad shape. But I'd like to sort of unbundle that a little bit, and I think that there's really 2 problems there. So there is the problem of financial viability of the utilities themselves, which is the utilities continue to be in poor financial health. They're over-leveraged. We haven't really done power sector reform, or we haven't done tariff reform for them to have, of any significant scale, for them to have really improved their balance sheet to be able to then, while they continue to, of course, something we take great pride in is that they honor PPAs, but sort of a delay of 9 months or 6 months or 12 months is in some way, form, and effect a default. Just because you did eventually pay does not mean but you didn't pay in time does actually affect the financial viability and the business model of the industry that is deploying the assets. So that there's a financial viability problem, which I think is perhaps the largest immediate challenge. The second power sector problem that I think is perhaps not a big challenge at the moment, but will be an extremely difficult challenge to tackle, and it's increasingly becoming more and more mainstream, which is around the technical viability of integrating the growing amount of renewable energy into the grid. And then the sort of the little bit of sort of the jostling between honoring your PPAs and honoring all of the clauses of the PPAs as they're written today, but also then maintaining the grid stability, etc. So this, and while grid integration, even the technological upgrades required for that have sort of a 3 to 5 year time period, the capacity of renewable energy capacity comes online much faster. So I think that in my mind would be then the slightly on the horizon, but very big challenge important to address. So those would be the 3 challenges in my mind. How do you solve it? Well, I think that there is a role to use the SDG framing, but not entirely. So to my mind, I think that the SDG framing doesn't have, is not a huge lever to mobilize private finance. Only risk return profiles perhaps drive that. But there is a role for the SDG framing to mobilize much more international public capital as well as domestic allocation of public capital towards addressing some of these issues, right? So To that, then, I would say that if you can use the SDG framing to mobilize pools of capital that could dedicatedly address the three risks that I'd outlined, perhaps the two power sector risks more effectively, where they can be designed as risk mitigation instruments where there's much more risk sharing, and you're able to design very specific fit-for-purpose solutions for both delays in payment, but also then for curtailment in the case of technical unviability of the grid to integrate renewables.
Thank you. Thank you so much. I can see Jonathan making notes, so I'll come to him next. So I'll start right with the SDGs once more. And my question to Jonathan is, have you seen the SDGs sort of accelerating action towards more finance for development, if at all? And where do you think it can actually help direct that movement? And the second question I had was that, what type of incentives, financial and otherwise, can be made available to the developed and developing countries to encourage the flow of private capital there?
Thank you very much indeed, and it's a great pleasure to be here on behalf of the European Bank for Reconstruction and Development as a member of the bank's executive, especially here in India, which became our 69th shareholder last year. This question of the SDGs, all of us as we're sitting around this room this morning should be pretty worried, I think, about the SDGs. We've set this target of 2030 for fulfilling the Sustainable Development Goals, including this big green agenda. But we may have willed the outcome. We've said where we want to get, but what we have not done as the international community is willed the financial means to get there. And although the clock is now ticking towards that 2030 deadline, the difficulty is that governments, because of the way politicians work, governments will not really wake up to this issue until just a few years before 2030. You probably won't be able to engage big political attention in many countries before 2025, with only 5 years to go and an awful lot of work left with no way of attaining those Sustainable Development Goals in the 5 years that are left. So I think we've got a big problem. There clearly isn't enough money, and there isn't the political will around the SDGs. So what do you do? What we're trying to do, not just us as one of the multilateral development banks, but the whole of the multilateral development bank system, we are trying to engage politicians earlier. We're trying to say now is the time that decisions have to be taken if there is a chance to hit those 2030 Sustainable Development Goals. You cannot wait until 5 years before. Are we having any success with that? I think it's still a big issue for politicians. I think the one ray of hope is that they are much more engaged by the Paris climate change agenda, which also plays alongside this, the COP21 agreements. There's more chance of getting them engaged on that than there is on SDGs. So everyone is paying lip service to the SDGs, but will it deliver the sort of improvements that we're talking about? I think at the moment there is good reason to be skeptical. Unless politicians come out of this torpor. Having said that, there is a lot that can be done. It's very clear that if the SDGs are to make any progress at all, we have to get more private sector capital into green investment. Kanika, you were just talking there about more international public money. Of course, as we all know, there just is not enough of that international public capital available. So I think we've got to smartly use that international public capital to do many of the things that you were hinting at. Actually, as we try to bring in the private sector, we will only reach these climate change and green investment goals through the private sector. So how do we smartly use that public capital, as you were suggesting? I think we've started to do it at the EBRD. We just over 35% of our investment in 2018 was in the green economy. We're heading towards 40%. We are taking a blended approach where alongside the private sector capital, including our own money, we are trying to make sure there is donor money and other public capital which can be blended in with some of the investments. I keep coming back, I think, to a quote from John F. Kennedy, which he used about the space program. In the 1960s, and when he was explaining why the Americans were trying to get to the moon. he says we don't do it because it's easy. We do it because we know it's hard. And I think that's exactly the same thing with trying to reach the green goals. These are immensely tough goals. So only by working in a smart way are we able to do it. So what are the priorities? I think it's to use that blended capital. And, we've had many examples in the EBRD that we've done that. If I think of Central Asia, for example, where we've got the first private sector solar plants in Kazakhstan. So what did we do there? There was a little bit of blended finance coming in alongside that private sector with some donor money to do some technical work alongside that private sector investment. But the other thing that is absolutely crucial, because otherwise the private sector is not going to come, is the work that we did directly with governments. So in the case of the Kazakh government, making sure, and the same with Mongolia, by the way, where we had the first wind farm, Salkit wind farm, is making sure the regulatory framework is in place, because otherwise the private sector will not come. Make sure that if there's renewable energy being invested in, that there's a feed-in tariff. So you actually get paid as the private sector for the energy that you're paying. It's a suitable green tariff. For making sure that once that regulatory approach and also that the green tariffs for paying for green energy are in place, that governments do not backtrack on it. Because we've seen in many countries that initially there are very generous incentives for the private sector, and then suddenly, at difficult times, these are withdrawn, and that damages the whole sector and makes it hard to bring further private sector in. The other thing that I think is important, the question of customs and all sorts of other tariff barriers to bringing technology into countries. In some countries, we have, customs barriers which make it very hard to bring green technology into countries. We have to work with the governments to get rid of that as well. So I think there's a lot you can do. It requires a much smarter approach. I was thinking this morning, actually, as I flew in, actually, on, if I think about how much, to give you some context as to how much really needs to be done. I think we're aiming by 2020, as the EBRD, through our investments, to reduce CO2 emissions by 50 million tons, a year. 50 million tons a year. Sounds a lot. So what does that equate to? It's the equivalent of about 6 million cars, I think, coming off the road, that sort of thing. Now, to get to that 50 million tons of CO2 reduction will require us, if we're looking at our 40% target range for green investment, to be investing in green something like 4 or 5 billion euros a year of our money to get to just 50 million tons of CO2 reduction. And that's, remember, that's not just our 5 billion, we probably bring in about 10 billion of other money alongside our 5 billion. So 15, maybe 10, 15 billion euros to get to just 50 million tons of CO2 reduction. So again, coming back to that John F. Kennedy quote, you can see how hard it is. And, Kennedy then went on to make the point about the space program, the Apollo program, that it would be a test of innovation, technology, and sheer willpower. Well, I think it's exactly the same in the green discussion. Right. If we are to get to there, we will need all three of those things. So we choose to do it because it's hard, and this will be hard.
It will be. Yeah. It will be hard, and that's probably the reason why we need more, direct attention to this. If it was easy, probably you would have finance flows happening. Thank you. I'll come to Geraldine next. So, talking about private capital, you represent, or OECD represents, the bulk of the GDP, the world's GDP, at least the nominal part of it, definitely as such. So, I would be quite interested to hear your views in terms of, when you talk to your representatives, what are the areas that excite them in terms of making investments to members to ideas in the developing regions or emerging markets as such? Are there specific areas that you would like to focus on? And my second question to you is that, from your perspective, what will it take to make these opportunities real? And what type of support can emerging economies and developing economies make available to investors from your member countries?
Thank you very much, Muthushi, and thanks, Aura, for the invitation. So we're sitting in this beautiful venue that's worth of a wedding, and I'm thinking that the answer to the question of, how to unlock green capital maybe you need to think about it like an urgent matchmaking problem. On the one hand, you have massive investment needs that lie mostly in emerging markets like India, where to address both development needs but also the climate challenge and broader sustainable development issues, you will need to massively invest in infrastructure that's low carbon and resilient in the next decade. Just to think about the order of magnitude, in the next decade, the world will multiply its infrastructure. So in 10 years, we will double our infrastructure that we have today. So the challenge is dramatic. But on the other hand, the matchmaking, the other side of the equation, you have trillions of dollars available globally. So there's no shortage of globally available capital. You asked Mutushi about OECD countries, and in OECD countries alone, institutional investors manage up to $84 trillion. So we have enough money. So the question is, how do we make sure that the incentives encourage investors to shift their investment away from carbon-intensive assets towards low-carbon assets? That's the first challenge. The second challenge is how to get them to invest more in green infrastructure. And the third one is how to go into emerging markets. And that's where there's a gigantic challenge. If you look at the statistics right now, large OECD pension funds invest less than 1% of their assets in infrastructure, period. So first, infrastructure itself is not an asset class where those kind of investors are usually going. And they invest an even smaller share in green infrastructure, and almost all of it is in OECD countries, like you said. So what can we do to attract them towards green infrastructure projects in emerging markets? So there's a lot of good news happening. The first one is, I'm sure you've all been following the boom of the green bond market. You know, it reached $500 billion cumulatively over the past 10 years, like as of 3 months ago. So it's a very important progress. The second thing that we're seeing in many emerging markets like India is the boom of the renewable energy market. And it's very promising to see how renewable energy technology, like Kanika has said, the costs have gone down dramatically. You know, utility scale solar PV is reaching record low auction prices in India, Mexico, many, many markets across Asia, Latin America, and even Africa. So it's fantastic to watch. But then the question is, how do you get those institutional investors and capital markets to be interested in those assets? And one other piece of good news is that since the Paris Agreement and since, you know, like leading personalities like Mark Carney encourage institutional investors to be more aware of climate change risk, we see, and Jonathan, you're right to say that investors are increasingly aware of climate risk, maybe more so than other issues. And they're increasingly aware that it's in their interest, in their portfolio's long-term interest, to integrate climate change considerations, because, you know, the IPCC report is telling us that we have 12 years to act. 12 years before dramatic change, and I think every one of us saw what happened last year, you know, with the wildfires in California, the massive floods in Kerala, in Japan. So it's already happening. So it's not a question of 30, 40 years or 50 years. They're telling us we have 12 years to act, and then it's too late. So we have 12 years to shift the investment structure. So for an investor, the question is, how do we increase green investment across all asset classes? So maybe there's 4 main barriers that Kanika and Jonathan have already touched on. The first one is each individual green infrastructure project needs to have a sufficient risk-return profile. And that means what Jonathan talked about, which is strengthening the domestic enabling conditions in each country to make the project more affordable and profitable. The second, and that's a big project that the OECD is working on, we in collaboration with all institutions, and it's a priority to make the enabling conditions more supportive. And the power sector, like Kanika said, is critical. The second aspect is we don't need individual projects. We need a pipeline of bankable projects, and that means coordinating the infrastructure planning at the domestic and subnational level. The third element, of course, is like for those investors to get in emerging markets, they also need to address their own barrier in OECD countries and other countries. And it's true that a lot of institutional investors confess that they lack the capacity, the due diligence, the expertise to go into new infrastructure projects. First of all, they don't have a lot of due diligence in infrastructure, but when they do have expertise in infrastructure, it's very often carbon intensive, like fossil fuel infrastructure. So they need to bridge the gap in terms of their capacity, and that's where I think development financial institutions like EBRD have a key role to play in matchmaking and improving the platforms for reducing the transaction costs for them. Of course, there are other regulatory barriers in OECD countries that may constrain the ability of those investors, but I think increasingly markets like the European Union are trying to look, for example, what the EU is doing on the EU Action Plan on Sustainable Finance. It's really raising the awareness of institutional investors and trying to overcome those barriers. And so maybe the last and fourth barrier that Kanika talked about is if you have institutional investors that are willing to invest in green infrastructure in emerging markets, they don't know where to go and they don't know how to invest their money, which investment vehicles, which asset class. And if you have a pipeline of bankable projects on the other end, then the matchmaking is then you need investment vehicles, investment platforms, matchmaking, and you need to bridge the gap so that across the asset class, capital markets can get into green infrastructure projects. I think renewable energy and energy efficiency is an interesting prospect right now.
Thank you so much. Very interesting ideas coming through in terms of, just matching the needs, looking at enabling environments, pushing political will towards making more investments. I think all those are very, very important areas to look at. So I'd now like to come to Sumant. I know you have had a tremendous journey over the last many years. You've lived it out in some ways, I think, in terms of looking at ways of establishing a new practice or an area that wasn't so much in attention a few years back. So from your perspective, I would really be very interested to hear, what are the 2 or 3 factors that you think have worked as an enabling area for you, which has actually helped you move ahead in your journey? And secondly, in terms of, are there specific instruments like a blended finance instrument or a green bonds? Do you think they have been fulfilling the objectives for which they were set out, and can they be improved? Are there areas that they need to be more specific?
Thank you, Matushi, and I'd like to also thank the ORA for inviting me for this panel discussion. So 2, 3 things that have helped along this journey. I think one obviously has been the Indian government's ambition to really aggressively grow the renewable energy sector. That I think clearly has helped us a lot. And in some ways, while this government obviously has taken it to a very different level with the target of 175 gigawatts to be set up by 2022, in some ways the base was laid by the previous government. And so there has been bipartisan support across the central government for renewables, deployment of further renewables going forward. And even if you look at the states, I think there is also fairly good support at the state level. And at the states, you have a multiplicity of different types of governments. So I think you can argue that across the political spectrum, there's clearly a very strong push for more renewables going forward. I think the second thing that has helped us quite substantially has been that over the last 8 years since we started our business, and for those of you who don't know about our company, we're actually the largest renewable energy company in India. We are generating close to about 4,500 megawatts of wind and solar energy. And this year we hope to generate almost 1% of India's total electricity production from renewable energy sources. And in that process, hope to mitigate almost 0.5% of India's total carbon emissions. So we've made some significant progress over these last 8 years. And what has really helped us quite substantially has been the fact that the cost of renewables has come down dramatically. And therefore, while in the beginning it was driven, when we started this journey, renewables was driven more by the fact that it was a good thing to do, it was a good thing from a climate change standpoint, and therefore there were renewable purchase obligation targets set on the various distribution companies. That's how we started off. But now, because it's the cheapest form of energy, it's therefore become that much easier for us to talk to the distribution companies and for them to become active buyers of renewable energy. I think that's been one very unheralded change that has happened. Actually, it's been heralded quite a bit. I shouldn't say it hasn't been. It has been heralded, of course, but I think it's underappreciated. The fact that renewables now is by far the cheapest form of new energy. And that should therefore drive the growth of renewables much more strongly going forward. And that brings me to point number 3, which is the fact that because it is cheap, because it is profitable, and perhaps because of all the things that we've seen happening globally that people have talked about here, there has been not a flood, but certainly a very large degree of interest among foreign investors to come into this sector, whether it's been on the equity side or the debt side. And that has really been the underpinnings that have allowed us to raise a large amount of capital from both, as I said, debt and equity sources, and deploy that into creating renewable energy assets in India. And I would say that we must have raised, as a company, we've raised more than $1 billion of equity, which is all from foreign sources. And we must have raised at least $2 billion of debt also from international sources during this time period. And the balance of the debt has come from Indian banks or Indian sources. But the fact that we've been able to raise such a large amount of equity and debt from international investors, I think is a function of the fact that it was profitable for these people to invest in the sector. And secondly, because of all the things that are happening globally that are causing investors now to invest more into this sector in India and in emerging markets in general. So I would say those are the three factors that have really helped us quite substantially. But beyond that, of course, like any other sector, this is a sector where commercials matter, creating a business matters, creating an organization matters, executing hard on the ground matters, dealing with all the issues and problems and local concerns that you have, addressing those in a timely way, that matters. Project execution, project selection, all of that is extremely critical. You can't get away from all of that. So all of that, of course, is sort of taken for granted that you have to get it done. Your second question was around what are the financial tools that we've used. Frankly, in our journey, we've been able to actually use or rely upon a lot of different types of financings, because I think one of our views was that you can't, just given the total amount of financing that we require, you have to access as many different sources as possible. And so therefore, on the equity side, as I said, we've raised money from pension funds, sovereign wealth funds, strategic investors, straight off private equity investors, clean energy investors, so a whole bunch of different types of people. And on the debt side, we've raised money from the international bond markets. We've raised money from bilateral institutions like OPEC, multilaterals like the Asian Development Bank, and also from the Indian domestic banks and so on. My experience on the funding side has been that while we have this big thing called green bonds, in actual fact, it's a bit of a fallacy. And the reason is that it's nice for people to stamp on something and say this is green and we are investing in it, but the reality is they don't give you a single basis point off. Okay, so the cost is not any better than I get from anybody else. So just because I'm raising it to invest in renewable energy, somebody somewhere sitting and saying, okay, this is a green bond and therefore, it looks better on my balance sheet or my annual report or something. But in actual fact, they don't give it to us at a lower interest rate. And so therefore, there's no real benefit that we get from other people being able to classify the loans that they give to us as green. And so I think that's something that needs to change. So in all of the, and I'll be a little bit controversial here, in all of the investments that we get and that we've raised, a lot of it from the OECD world, all of it comes at absolutely commercial terms. There's nothing that comes on the basis of the fact that this is climate change oriented, this is good for the environment, and therefore let's give it at a subsidized rate. It does not happen that way. And so, while I hear a lot of talk about a lot of these things, the reality is, in actual fact, it doesn't really help us in significant ways. I mean, funnily enough, the only one who's given us slightly lower than cost funding is OPEC, which is a US-based lender, which you would not really expect to be the ones that would give us the cheapest source of financing. But that is really the reality that we've experienced so far.
Thank you. Yes, in fact, I would just wanted to, that was very interesting. I would just like to open this up to the other panelists to have a comment.
Yeah, I'd like to jump in actually, because you raised some interesting points there, Sumant, and particularly this question of whether green lending in effect should be subsidized, green financing. So if I look at, for example, the EBRD rules and the way we've been, since we are not allowed to undercut the market. So we always charge commercial interest rates, even as a multilateral development bank, because we have to be additional to the market. Is that right? I mean, the one thing I would say about it is that I think it really means that if investments are to happen, they are the right investments. Because if they're capable of being funded at commercial rates, that means they are the right investments. And I think from that point of view, that is very good for the green market, because it is probably an efficient allocation of where the money should be going. Because if they're not capable of being sustained at commercial rates, then they may well be the wrong investments. The other thing I would say is you raised the question of profitability. And I think that's crucial. This will not be resolved, this issue, without the private sector piling in. And it has to be profitable. And I've noticed, that there has been a sea change, I think. If I look at the clients of the EBRD, one comes to mind. I remember going to it's a very big food manufacturing operation in Serbia. And they were very fuel inefficient. And we persuaded them to invest in using biomass energy, because they had huge amounts of waste from their food operation, which could be recycled. Now, they were very skeptical at first, but once they realized that actually it was helping their profitability, once we funded the new energy systems in their plants, they became absolute converts. So I think that it is possible to be really profitable in this area. And I think that will pull in more and more private sector investment. The other thing I would say is I don't think this lending should be subsidized, but I do think that's where the smart use of blended finance comes in. Not as a subsidy, but in using public capital in smarter ways. Whether it is, for example, in technical cooperation work, which goes alongside a loan, or some other, that's where you bring your donor money in alongside a loan. So you're not really subsidizing the loans, but you are giving something alongside, which is coming from public sector money. So I think it needs to be smartly done. And if we don't get those incentives right, actually we won't get that private sector capital investment. But we are seeing it more and more. You travel around Asia. I see it more and more around Asia. It's Central Asia in particular, where we operate as one of our regions of operations. You're seeing it in Kazakhstan, as I mentioned. You're seeing it in Mongolia. It is starting to take off, and there are big plans in Uzbekistan, which should be absolutely ripe for renewables, but has not been up until now. So I think, that is going to be private sector led. That's the only way it can be done. So I think we are making progress. For all the worries about the speed of progress, for all the worries about whether it can be profitable for the private sector, I think there are examples where it's beginning to work. It's just getting that momentum.
I know, but Geraldine Geraldine talked about the fact that we have 12 years left, right? Today, as a globe, we are adding about 200 gigawatts of wind and solar every year. The total installed base of all power in the world is about 6,000 gigawatts. We're replacing at the rate of 3% every year, which is not even probably meeting growth of power. So clearly we're not going fast enough, right? Now the point is, if in fact people were serious about increasing the pace of this rollout, I agree, you can only subsidize up to a certain point. And ultimately commercial capital needs to come in, because that's the large pool of capital out there. But as you said, you have to find ways of using that capital to get the best bang for it. For example, to give you a simple thing, in India, our cost of borrowing in Indian rupees is very high because of rupee depreciation and so on. If you were to hedge it, for example, if you were to borrow from dollars and hedge it into rupees, it costs us about 4 or 5% a year. Now, if somebody could give us some sort of a hedging mechanism at a lower cost, that would actually bring down our cost of borrowing by about 2 or 3% potentially, and would allow us to therefore bring down the cost of the power that we sell to the distribution company by almost 10%, which would in turn therefore mean that the buyers of that power are going to be much more incentivized to buy more of it, which would allow us to roll it out faster. So there are various ways in which we can get capital to come in, leverage it in the best possible manner, but that particular capital may not get the full return of 4% for hedging. It may get 2%. So I think we have to find ways and means of getting the best bang for the buck. And actually there is a case to be made for some capital to not get full commercial returns, to be able to deploy renewable energy faster. That is my only point.
Thank you. Thank you very much. The very interesting set of comments and observations coming through. So I will now open this out to the Kanika. Geraldine, did you have any comment on what was said earlier? There will be a We'll loop back. Oh, great. So I would like to open this up for questions, comments from the audience. 5 questions, and if you could just come to the aisle and sort of say your name, organization, and your question. And also especially invite the fellows. If you can just come over if there are any questions around. And also if you could tell us who in the panel you would like the question to be answered.
My name is Dr. Sharma. I have a question to the panel. If we have a look at the global data on green investment for last 5 years, of course, it's been close to about 300 billion US dollars every year. During 2017, of course, the total investment was about 300 billion US dollars out of the total energy investment of 1.7 trillion dollar. Oil investment remains at about $1 trillion US dollar. Now the shift is not happening from the high cost carbon emitting fuels to the green investment in energy terms. Now, neither Paris addresses this, nor UNSDG addresses this. Now, what should be done? I mean, how do we educate the world leaders on this issue to pump in large green investment by the government agencies?
Thank you. We'll take a few more questions and then anybody? Yes, please.
Hi, I have 2 questions. One is related to something that you have already discussed. So the motivation for the green transition. You have mentioned the subsidizing the industry. What other potential incentives we can actually provide in order to have a real green transition? And the second question is maybe more philosophical in its nature. Is it actually possible to have a proper, real green transition, and how is it compatible with growth? Thank you.
Thank you. Any others? We can take 3 and then come back for another 2. Yes, please. You had a question?
Good afternoon. I'm Prashant Vazay. I work at Climate Bonds Initiative. I wanted to just ask a question to Jonathan. It's really sort of playing back the points that Sumant made, which are very important. That we're talking about a situation where the vast majority of deployed solar at the moment is in countries without much sunlight, so Germany, Spain, Japan, even UK, where we're both from. The areas with the highest amounts of sunlight are within sort of 30 north, 30 south of the tropics. But we've got a position now where we're still not, in any sense, subsidizing deployment in these more rational places. There's the relatively cheap cost of finance from international sources, but then there's the currency hedging cost, which someone's mentioned is between 4 and 5%, which is essentially another surcharge on developing countries for borrowing from international markets. The cost of using rupee bonds is 7.5%, 8%. That's the price in domestic markets. This is a misallocation of sort of scarce resources and renewables at a huge scale. Shouldn't the MDBs be thinking about this?
Thank you. So I'll...
Yeah, shall I answer that one first? It is very specific. I think you're absolutely right. I think that the MDBs have been very slow in moving to more local currency lending. And they have stuck on the whole to dollar or euro lending, and that has made life very difficult for the private sector or for investment in some countries. I think the shift is happening. Within the EBRD, I think about a quarter of our lending last year was in local currency. We've really put a great effort into local currency lending. It's not easy to do. We've had local currency bonds that we've raised in order to fund that local currency lending. The risk is obviously then transferred to us as opposed to the people that we're lending to. We are committed to doing more. I think though the issue you raise is even deeper than that. In that misallocation, I guess that the investment happened, you mentioned Germany, you mentioned, other not so sunny places. It happened because, of course, they were enthusiastic at the beginning and pioneered it. we have this situation now where the countries where it's more, as you would put it, rational to do it, are playing catch-up. I think that catch-up is going to be a lot faster than we think. If you look at the rollout of solar farms, you know, if I think about even in the Middle East and North Africa over the past year, you know, those are prime areas where renewables should really be absolutely king. We are seeing a massive takeoff in renewables in Egypt, where, in fact, we started there, what was at one point the world's biggest solar farm, but that record doesn't stand for long these days, because very soon another one comes along that's even bigger. You've seen it in Tunisia and Morocco, you're seeing it in Jordan. You know, a lot of countries where they've been heavily reliant on fossil fuels for a very long period of time, and often imported fuels as well in the case of Jordan, which left them in difficult situations when there were supply changes, abrupt supply changes. We are seeing definitely an absolute embracing of renewables, and that's a result of investment by the private sector. And the reason the private sector now feel comfortable is because actually all the effort that's gone into those countries around the regulatory framework to make sure there is a proper green tariff regulatory framework for renewables. So I think things are shifting. You know, why were renewables in effect misallocated to these less sunny places? It wasn't just the fact they were pioneers, it was the fact these were countries where the regulatory framework was easy to put into place initially. So as a result, then people felt comfortable about going down this road, together with the commitment of those countries towards green. I think we're seeing the copying of emerging economies of these regulatory frameworks from wealthy G7 type countries. And I think that's making a big difference. So I think coupled with more local currency lending, those two things are really helping the takeoff of renewables. The one area I think there's plenty of reason to be worried about because it's so far behind is Africa. And I think that's the next big challenge, the green investment in Africa.
Thank you. Geraldine.
Thank you. So maybe I can take on the second question first on the link between climate change and growth. And I'm really glad you raised that up because we now have the research that shows that we no longer have to sacrifice economic growth to act on climate change. The OECD led last year a groundbreaking report at the request of the German G20 presidency called Investing in Climate, Investing in Growth that really demonstrated that not only do you not have to sacrifice economic growth to deliver on climate change action, because the cost of investing in low carbon resilient infrastructure is largely offset by energy savings, for example, and other benefits, but also the cost of inaction if we do nothing will hinder the GDP in the medium to long run. So that's the first point, is that it's no longer a question of trade-off between growth and climate change action, and I think it's a dramatic change, and we held many sessions in collaboration with ORF over the past 2 years to really outreach on that key narrative shift, and I think now there's an increasing awareness that this is a done acceptance, this is accepted. The next step is how to do it, and I think it's very welcome to see what Jonathan is saying, and we're digging into the technicalities because we can actually afford to. I think we couldn't have had a panel like this 5 years ago because 5 years ago we would have had to make a case for ourselves before to dig into, you know, like local currency and hedging and other blended finance, etc. So I think it's happening quickly. On the first question that you raised, sir, on the, you know, how to convince, because the green investment is not nearly enough. You're completely right, and I think it echoes something that Sumant said earlier, that, you know, we really need strong, predictable signals for investors to invest, and we cannot be short of stressing that policymakers need to send very strong signals for investors to have the confidence to invest in green infrastructure. And, you know, India is a fantastic example because when setting their very ambitious target of 175 gigawatts of renewable energy by 2022, I think it did send the right signals to investors, and we see the positive results nowadays. So regardless of, you know, in financial sector, financial investment doesn't happen in a vacuum. You need the enabling conditions, you need the predictability, the signals, etc. But what's interesting, I think, is that beyond the role of governments, we see today on that panel that all stakeholders need to be involved, you know, philanthropies, development financial institutions, civil society and private sector and international organizations in collaboration with governments. And I think it's a critical point that if you have the goodwill of investors to invest, but they don't know where to, and if you have the goodwill of governments, but you know, there's that matchmaking issue that I was referring to, then it really needs to be a strong collaboration between all type of stakeholders. And I think I'm very glad that the panel is moderated by MacArthur Foundation, because it shows that all types of stakeholders do need to engage to help bridge, you know, investment vehicles, you know, enabling conditions, pipeline of projects, capacity building. And that's just to flag that the OECD is launching as of this month a new program on clean energy finance and investment mobilization in 5 emerging economies, exactly to achieve that matchmaking and that collaboration among stakeholders to unlock private investment, including from institutional investors in clean energy. And we'll be collaborating closely, I hope, with all stakeholders around that panel and in the room in India and in other South and Southeast Asian countries. But I think it's very welcome to have that collaboration and dialogue.
That's good to know that, you know, we've got the right representations and the right points of view. Kanika.
Thank you.
Yeah.
I think Dr. Sharma's question as well as the following question around incentives is quite similar. I mean, the numbers can be sort of looked at in any way, right? 34 billion is not a small number. It's up from previous years, etc. India is the second highest developing country recipient of it, but that stands and has plateaued at about 10 billion for the last 3 years. So although 10 billion buys you more renewables now than before, it's still not a growing number. So what are sort of the incentives? And I think that is exactly what the second question was as well. And I'd like to sort of answer in 2 parts, so carrot and stick. The carrot, I think, is, you know, as Sumant was saying, from the business point of view, is also true from the investment point of view. If it's the best investment you can make, that is really the best way to do it, right? And so what is then inhibiting the sector from becoming the best possible energy investment? And actually India is a good example, because if you see in the last 3 years, new investment from domestic banks, so not all exposure, but just new investment, it's tilted heavily in favor of clean energy. And it's just because the terms are better, the returns are better, the signals are stronger, and they know that sort of the volume of turn, etc., so they don't have to hold it on their books for long, it'll get refinanced, all of that. That being said, I think that there is still much to be done to create a strong secondary market and a more liquid secondary market, and I think that there needs to be much more effort directed towards that. And I think that, again, strong credit rating is going to play an important role in that. How do you make projects more bankable? And that's going to be a function of both regulatory improvements, as Jonathan was saying, but also of some artificial sort of security blankets that you put in place to make sure that new categories of investors come in. I think Sumant's sort of story about Renew is an optimistic one, but it is also not the norm. I don't think that, I mean, not all renewable energy companies, and perhaps not most renewable energy companies, yet have access to pension fund money, etc. So what are some of those ways that you can do the matchmaking that Geraldine was talking about? But also, very interestingly, something we haven't talked about at all today is on the stick side, right? So how do you make renewable energy or clean energy the best possible investment from just a price point? And that's by pricing externalities. And it's a debate we don't like to have very often in India, and several parts of the world are sort of iffy about it, increasingly so. But when are we going to start pricing pollution? When are we going to start pricing climate change? When are we going to start introducing climate risk into investment decisions? We are still not doing much of that. And I think that the minute we are able to sort of determine a price for carbon, even if it's a shadow carbon market like we already have in India, both in the form of renewable energy certificates, but also energy efficiency certificates from the PAT scheme, we already have a shadow carbon market. We just need to embrace that, strengthen it, bring in some sort of order to the entire market, and create that market to be as robust as the physical clean energy market. And the minute you do that, renewable energy and all other clean energy becomes the best possible investment option, and that changes the game significantly.
I think there's another stick as well, which will increasingly come into play in the years ahead. And we're starting to see it in a few countries, and that is that investors, whether they are sovereign or non-sovereign, wherever they're coming from, will be worried about being left with stranded assets, about assets, that are not worth investing in if you think about the 20 or 30-year payback of a coal-fired power station or some sort of oil investment, and I think increasingly people are worried about that, and I think that will deter investment increasingly as we go along in non-renewables, non-clean sectors. And that could be quite a big stick, and we're seeing it. And if I think again of countries like Mongolia or Kosovo, both of them have cheap coal. Both of them have been desperate to fund coal-fired power stations, and they haven't been able to get that investment because no one wants to put their money into that because they're worried they're going to be left with an asset they just cannot use in future and cannot get a return on. You end up with stranded assets. So I think that stranded asset question will increasingly come into play, and that will push people into renewables because the alternative is to be left with assets that are just diminishing in terms of the return, and dangerously, won't play out. They won't last the lifetime they're designed for.
Thank you. No, this has been very interesting. I hope for everyone here in this room today. Before we end, I'd just like to ask each of the panel members with one sentence talk about what you would like to leave the audience with from the discussion that we have just had, just to think over in terms of, how do you make this happen as we move ahead, given your area of respective experience. Geraldine.
So I think for me, it's exactly what, I like what Jonathan just said on stranded asset. If you're an investor in the room, think about how you want your portfolio to look at in 12 years when it will be a rush of panic because of stranded assets. Do you want to be in that rush where there'll be a bubble, there won't be enough market depth, and the cost of the transition will be high, or do you want to anticipate it? If you're a policymaker, I think we cannot stress it enough, everyone has said it on the panel, that you need the predictability of the signals because not only of climate change, but all the co-benefits, because of local air pollution, because of associated health costs, because of the job creation potential that renewable energy can bridge, and because of other security and other aspects that can be of concerns across policy areas. So you need to align your portfolio. For me, the key thing is the dialogue between investors and policymakers is critical, maybe.
Right. Thank you. Sumant.
Yeah, I think for me, the point is that renewables is really an opportunity which comes along once in a lifetime, and we are in the midst of an energy transition of the kinds that we haven't seen in generations, and I think that we're just the beginning of that whole process. So there are going to be a lot of opportunities in this sector going forward, lots of business opportunities, lots of career opportunities, lots of think tank opportunities, lots of different kinds of opportunities to keep a lot of different kinds of people busy. But there are going to be a lot of twists and turns on the way as well. And I think that the nature of the industry will change. I think to the point that was brought up here about investments in the sector, right now, one of the reasons why the investments in the sector are still small compared to oil and gas is because the large oil majors have not yet made the transition mentally. Once they make that transition, and I don't know when that might happen, and maybe we need the stick approach, maybe we need a carrot approach, maybe we need more pressure from somewhere. I think once that change happens, you'll start suddenly seeing a lot more, tens of billions of dollars coming into the sector, and that is when the sector will really become much more mature. Today, it's still early days, and I think governments have a role to play in that. And I think that we don't have sufficient time. And I think for all the people who think that we can take it one step at a time, I don't think we have that luxury either. So this is all going to happen in a very compressed time frame. And it needs to happen in a compressed time frame if we are to use it to address the whole issue of climate change and so on. So I think the sooner people get into it, the sooner governments really turn their minds to it, the sooner large investors turn to it, the better for everybody concerned.
Thank you. Thank you so much. Kanika.
So I agree actually with what both Geraldine and Sumant said, and I think that Sumant's absolutely right when he says that the energy transition is well underway. There's no turning back. So really the only thing to deliberate now is how timely is it going to be and how efficient is it going to be from a resource point of view, right? So, and in order to advance both of those ideals, then I think that coherence will play a really important role. It's important, I think, for all of us to think about how to have a strategic, coherent idea of what this transition means, and then the role that each stakeholder in this room is going to play in that. So how do we sort of, how do we build that coherence and understand each other and speak the same language? And I think that there is a huge risk perception problem which will actually go away the minute we're all able to understand each other better and speak the same language, and sort of data and other related enablers of that.
Thank you.
Yeah, I think my final thought would be on technology and innovation. I come back to the parallel with the 1960s race to the moon. You know, that was achieved through technology and innovation. I think it's exactly the same thing in the green economy, that the only way that more and more private sector money is going to come in is if there is further technological innovation. And in fact, the private sector will push that technological innovation. And in pushing it, it will become more and more clear that renewables are the best way. They are profitable. They are the best way to provide energy. You know, we will make those incremental gains over the next 12 years. And if we couple that with continuing to work smartly with what little public money there is available, then I think we've got a chance to succeed. But it is still a chance. You know, Sumant, you mentioned the time frame. The time frame is really tight. And we have to continue trying to raise the consciousness of politicians.
Thank you very much. I'd like to thank my panelists. Thank you to ORF for organizing this and invite